Gilbert, let's drill down a little bit further. You identified some of the buyers and sellers in the market today, and maybe you could just amplify on that at TAD, and also focus and be as candid as you can be in terms of who should be realistic about what their fortunes are. In other words, should you be a seller? Can you be a seller? Can you be a buyer? Should you be? In terms of what you see in terms of where the market dynamic is taking us.
Yeah, maybe I will comment on three different components. First being ETFs, second would be mutual funds, and then third will be retail alts, which is an interesting area. But with regards to ETFs, the market itself, as mentioned earlier, is consisting of 20 players that have a lion's share of the total assets under management, and so the buyer universe will be in that group, as well as new entrants into the market that have felt that it's better to acquire than to build something from scratch. Who are the sellers in the market? Within that group of 20 to 35 that are large, there are some independent players that have built a fantastic infrastructure, not only in terms of launching ETF products, but getting them to developing products and then getting them to scale in terms of selling and using digital marketing, as well as having a very, very good distribution network internally, wholesaling network to target the wirehouse and broker-dealer community. Unfortunately, there's only 5 of those that are independently owned, and some of them have become much larger day by day, and so becoming less and less affordable for the bigger players to acquire them. But those are the likely sellers of the bigger firms. And I think, time will tell, but I think, waiting until when you're 50 or 100 billion is probably too late, because you'd be worth, several $billion in enterprise value, and it would be very difficult to afford that. But there could be also opportunities for ETF players that are smaller than 5 billion, less than 1 billion, where they have the track record in product development and have launched some interesting products that have taken up good demand from retail investors and have cracked the code on digital marketing, but really don't have the capacity or the capital to invest in distribution to be able to enhance the AUM profile. And for those, what's very interesting is for them to sell a piece of the business, or sometimes even control interest in the business, to a partner that can bring to the table those distribution that they would need. We see that again, with the Samsung deal with Amplify, 4 billion of assets under management. It was primary capital that Samsung put into the business for growth, and they are actually supportive of the eventual M&A transaction involving a consolidation deal with ETFMG as the target to double the AUM. So that type of transaction is something that we see, where you have a player that's new to the business wanting to get in to provide distribution help or capital support. So that's sort of the buyers and sellers in the ETF arena. On the mutual fund side, very similar situation, although the number of players that are large are much, much more. When you look at, mutual fund complexes with 20 billion to 150 billion of assets, there's 54 of them. So a lot more than, the 5 that I mentioned earlier that are at scale ETF players that are independently owned. And, the usual sellers of these mutual fund complexes, as earlier mentioned, would be global financial institutions, where they don't view asset management to be a core business. They could be in insurance and banks and other financial services verticals, and asset management, happens to be one of them. And, when they do the math around, the capital that they might get in a divestiture of the asset manager, in a, nice upfront transaction, consideration, then it could be they're better off, deploying that capital elsewhere. And so we see that those that are owned by those larger financial companies are likely the ones to sell these mutual fund complexes that are large. Public markets as well, public investors, with the valuation multiples of many traditional firms, which are depressed, there could be a takeover bid from a larger competitor, which would make those public investors be willing to sort of just sell and take cash, for their interest in the public company. Private equity obviously also owns some of these mutual fund complexes, and there will be a finite life to their investment, and so they'd be sellers as well. who are the buyers? The larger firms, right? If you look at who's bought big, mutual fund complexes the past several years, it's Delaware and Macquarie, it's Franklin Resources, it's Touchstone. So it's really those that are wedded into being in mutual funds and want to get scale, because it is a decent trade to be able to buy at 2 times revenue, 3 times revenue, but not take on any of the costs or majority of the costs. And so the implied EBITDA multiple in those deals will be in the mid-single digit, which is a very strong multiple from an acquisition perspective. So that's that in terms of the buyers for larger mutual fund players. For smaller ones, you've got Neil Hennessy and his firm have bought 12 different funds over their history. And so we do see that also with fund adoptions and taking on 1 or 2 mutual funds, 500 to $1 billion of AUM. Lastly, as it relates to retail alternatives, no surprise, it is an area that is significantly growing. The interest level from high net worth and retail investors to get exposure to alternative strategies continue to be strong. And the good news is that there are product vehicles today that allow for the mass affluent and retail customers to be able to afford the minimums of those strategies, as well as not get K1s, right? Get 1099s from a tax reporting perspective. That's why if an alternative manager is able to crack the code in terms of developing those products and then know how to sell them to the retail customer through the financial advisor community, that's a winning formula for growth. What that really means is that if you are a platform and you offer BDCs or REITs, closed-end funds, interval funds, or tender offer funds, and you've built a wholesaling network that has been able to sell and grow these assets, you will be highly attractive to large institutional alternative firms that are looking to crack the code as it relates to that market, as well as with large diversified firms that continue to want alternatives offered to their retail clients.
Neil, again, as historically a very active acquirer, do you see the market the same way, or do you see it differently? What would be in your mind, the demarcation line between the buyers and the sellers?
I wasn't listening to Gilbert. Only kidding. This on? That was a joke. At least it seemed like a joke. No, there is going to be a consolidation on the mutual fund arena, just because managers are getting older. For instance, I'm 67 years old, I've been in the business 44 years. How do you liquidate? We're a publicly traded company, so that's a whole different story. But there's managers out there that don't have the succession plans, don't have the family, don't have anybody. So how do you take care of your people? What do? You can do an ESOP, sell it to your employees, and hopefully they continue to go on. Or you sell to us, you got $500 billion, $2 billion, $3 billion in assets. We're a small player, but we can take you out of the game. One of the real interesting challenges out there is you don't necessarily need to be taken out of the game, but you can get liquidity. For instance, a lot of the transactions we do now we'll acquire or asset purchase agreements. So we'll acquire a management contract and then sub-advise back to them. So if they have $5 billion in assets, they got $500 million in a mutual fund. What do you want to be fooling around with $500 million, just the overhead and the regulatory problems and the risk? So they sell to us. They get cash off the table. We sub-advise them back to them, and so they're still running $5 billion. You're going to see more transactions like that because that's going to give them some liquidity. At the same time, the money really now is chasing the registered investment advisor market. And so if you're a wealth manager, you're going to get somewhere between 12 and 17 times, okay? In the mutual fund arena, as a plain vanilla, you're going to get 7.5 to 9. So where do you want to put your money for a return? So if they take money off the table, which they will in the mutual fund arena, then they can put it over here without going into their own pocket to build the wealth management side that's going to give them maybe 2 to 1 better return than they had. So I think you will continue to see more smaller mutual funds in the $500 million arena sell.